Now, as we pivot into U.S. data, you've heard us talk about some of the surveys and the way the data is collected. And I thought this was a really good chart because the response rates for a lot of these key data surveys is dropping. And you have to think about it. And again, like as you can see, they were never 100%, and they were never, some of them weren't even struggled to be at 50%. But there's ways in for those that know calculus, that know mathematics, like there's ways to account for the level, and then you can extrapolate. But as the response rate comes down, it becomes harder and harder to extrapolate because the sample set shrinking, so your extrapolations on the broader market is coming from a much smaller subset. So you're going to get a much bigger margin of error because you might be speaking to 40% of the respondents, and only 10% of them really equate back to the broader market. And that's what's creating some more of this volatility and some of these unknowns in the data sets. The JOLTS, I think, is the most interesting, where the JOLTS, when you look at the rate of response, has plunged to just under 31%. So in 2012 and through most of it, it was probably closer to 65, 70%. So almost 40% less people are responding, and it makes it very difficult to get kind of a clean read, which is why we talk so much about broader data sets, why we look at so many different things, because there could be an anomaly and you have to adjust for that. It's like, hey, this is a good number, but when you break it down, there's a little bit bigger margin of error, which is why we showed the difference between payroll, non-farm payroll, and the and the household survey, because which one is right? They're both showing different numbers, and the whole thing is, what we've been saying is they're both wrong, but they're both wrong in varying degrees, and we have to look at, there will be a convergent in the middle. But by looking at so many different data sets, you can kind of get a picture of, okay, well, where's the trend? Is the trend down? Is it up? Is it sideways? Is there going to be a convergence in contraction and expansion? And as we showed with the household survey and the non-farm payroll, it was going to converge in expansion still. Like we were still seeing enough out there to show a convergence in expansion. We think that is now waning, but again, so far we've been right, and it's because we look at so many different data sets and take the time to do so, as painful as it can be sometimes, to come up with that kind of data. Now, when we look at the measures of inflation, here you can see that core CPI is down versus last January. But again, it should be down versus last January because you're comparing one versus the other. So if it was 6.1 last year, so it's come down. But again, you see just how high it is, even though the comps are getting harder. And as the comps get harder, we're still seeing this movement. And I think it's a really important point because in December, if you remember, we showed quote unquote deflation of negative 0.1. And we had said to people who take the time to listen to us or watch us is that we saw inflation increase. Like that number is wrong. And we said, like, look, based on this data, based on what we've seen, like we didn't see deflation. We didn't see massive inflation. And as we said, like we thought it was going to be up 0.1, 0.2. And it's interesting because they revised it, and you'll be surprised to know it was revised from negative 0.1 to positive 0.1. And it's because of what we just talked about with the fungibility with some of these data sets. You have to start looking at the revisions, because the revisions are getting bigger and sometimes they're moving in the wrong or right direction. That's why we like to talk about that a bit more. Now, one of the bigger concerning pieces and a driver of what we think is going to be core CPI, Cleveland median CPI is over 7%. That's the first time it has happened since going back to the 80s. I mean, you're looking at, this is an acceleration. And when you look at median CPI, trimmed mean CPI, sticky CPI, they are all well above core CPI and are actually showing an acceleration versus January of 2022. So that's why we see a lot of stickiness. And as we keep talking about, we see it in sticky inflation, we see it in headline inflation, as well as core, where there is no pivot. And that's one of the things that we keep talking about is based on the jobs data, based on the retail sales numbers that came up that we're going to talk about in the next segment, based on the inflation data, why is the Fed pivoting? Like, where is the Fed going to pivot? Why are they going to pivot given all of the data? There is not a single data set out there that says, oh, the Fed is going too hard, too fast. Like, if anything, it's showing that they have to continue to go up. They have to continue to rise and get what we've been saying that they were going to get between 5% and 5.25%. We think it's now firmly 5.25%. Now, here's some key 3 inflation buckets that Powell has highlighted in the past. Core services tick down, but they tick down in a sense where it's ticked down, but now it's starting to pivot back up. Like when you're getting this flatlining, which is what we've been talking about. Again, that's stagflation. Core goods turned positive for the first time since August. Now remember, we've said core, the commodity side was seeing some down move. It was services that was keeping us up. Now we saw that pivot up a bit. Again, diesel was up, gasoline was up. Gasoline has come down a bit in February. It has not erased the increases from Jan. Diesel's come down. So on a month-over-month basis, February is going to look better than January, but February prices on gasoline are still well above December. So that's why you have to put this all in context when you're the consumer and you're looking at it. Shelter, again, flatlining, but still going. It's still in that increasing level. And when you look at the CPI inflation, 3-month average core, 3-month average headline, you're getting a little bit of that pickup, which is where we see some of these bigger concerning pieces. And so far, credit spreads have not widened despite the Fed is talking aggressive rates. And that's what they're looking at. They're looking at rates. They're looking at asset prices. They're looking at things to show how is the market handling this, and it's handling it in stride. So why is the Fed going to pivot quickly, given the fact that there's clearly still more to go? We're not even back to where we were in 2000 or in 2006. And that's why, again, we still see that target going closer to that 5.25% and probably 5.5% at this point, and we're going to stay there. And I think that's something the market is starting to price into it, given where things are. But bulls coming back. When you look at the spread between the AAII US investor sentiment, bullish readings have increased, and it's the highest since November of 2021. Retail investors, very bullish. And that's why when you look at some of the data sets, you had, the pain trade was to the upside because people got too bullish. Now people are getting people were getting very bearish. So the pressure was to the upside. Now people are getting extra bullish, which means that there's going to be some of that movement down to the downside, especially as the market, again, starts to price in that terminal rate. So the terminal rate moved up to closer to 5.2%, and that's where we continue to see some of those shifts. And if you look at the proxy Fed funds rate and the effective Fed funds rate, where the 6% is real. And that's why we see more of this pressure going up, more of these things moving. And some key components of that is the U.S. inflation still showing high breadth. And when you look at the things that are seeing price increases, it's high, and it's over 3% year-on-year growth. When you look at it in terms of the components, we're still over 70% of the stuff in the world that we're purchasing is still going up, and it's still increasing at a sizable clip. For anybody that has tried to buy anything, you can attest. It's like, wow, like I thought inflation was slowing, and then you go to the food store week on week, month on month, and you're like, man, like how did these prices go up again? Like what? Like when is it going to stop? For anybody that's been out to eat, you're looking at these prices. You're like, a burger's how much now? You're charging extra now for fries. How much are fries? You're charging now to use a credit card. Plus, you have an inflation adjustment fee. Like it continues, and the reason why is because when you look at leisure and hospitality, Look at how sticky this is. Look at how prices continue to go up. 7.2%. It's paused at different times, but it continues to go up. But going back to 1998, it's the highest it's been. So sticky service wages. Median wage growth continues to soar for leisure and hospitality of 7.2%. Wage growth tracker is the fastest paced in history based on the data. So again, you're looking at this as like, well, where is this going? Like why is the Fed going to pivot given some of these data sets? Now, on the positive side, January marked the fourth consecutive monthly contraction for rent index, came in at negative 0.06% drop, was the weakest of the bunch. Coming in December was negative 0.26%, November negative 0.41. So the contraction was the weakest. So you saw some rent, drop. You saw some of that. Now you're starting to see it creep back up. And again, that's a problem when you see it where it's still negative, it's still moving down. That's a positive in terms of the headline number. But the pace in which it's going down is ebbing. And that's what we've continued to talk about, where you're starting to see some of this flat line and actually some of this increase. Retail sales in year-on-year terms starting to hook back up. But keep in mind, this is in nominal terms, but 6.4% gain in January was up from 5.9%. So again, still a positive on the retail side, but we want to look at some of those key drivers. Now, CPI came in at 0.5% month on month versus the estimate. And then in the prior, it was adjusted back up to 0.1. So when you look at inflation, there's no dip. There was that small little dip in the summer, but core never went down. And now when you look at core, it was expected to be at 0.4, came in at 0.4, and last month it was 0.3. So you're seeing that acceleration again. And it's not that we're going to accelerate once more. It's just there's nothing showing it's going down. And given where inflation is and how it continues to trend up, that's going to be an underlying problem, especially when you look at in the 1970s, inflation started to come down in 76 and 77. It was coming to 5%. It was moving in the right direction. So they said, okay, now's the time to cut. And it immediately reversed and went into double digits. And they want to avoid that. Now, when you look at the CPI urban consumer year on year and core, you get an idea on how it's flatlining, and the comparison back to the 70s when they started to pivot in that 75, 76 level. That was where it started to drop, and they thought it was going to drop further. And instead, you can see it accelerated back to over 50, close to 15%. And they don't want that to happen again. Hence the higher for longer and not seeing that drop in general. Now, when you look at the Philly Fed data, February Philly Fed index fell to negative 24.3 versus the estimate of negative 7.5. New orders fell into contractionary territory. Prices paid edged higher. But remember, prices paid edged up. And again, that's inflation. They actually went higher. Even though things are in contraction, even though this is a steeply contractionary number, anytime we've been at this number, we have been in a recession, or we were right heading right into a recession. Instead, that's again that stagflation piece of no growth, negative growth, price is still elevated. Work week dipped back into contraction and shipments fell, but are expanding. Employment ticked lower, and then when you take it to the empire level, so per the Empire Manufacturing Index, outlook for labor has fallen to the lowest since mid 2016, and I think this is a big shift in terms of where things are and what this is going to do going forward. Now, when we look at PPI accelerated. January PPI came in at 0.7% versus the estimate of 0.4. Now, it was the previous was revised higher. It went from negative 0.5 to negative 0.2. Core PPI came in at 0.5 versus the estimate of 0.3. Fastest gain for headline since June of 2022. Fastest gain for core since May of 2022 since June of 22 for headline, core May of 2022. So again, you're seeing a pivot, and this is again showing the pressure points and the problem we keep seeing in terms of it's relentless. And we're not seeing the levels we saw of over 1%. And for anybody that has been following us, we have been very consistent. We have never said we were going to see that spike back. We have been saying it's going to clip at 0.3%, 0.5%, and it's going to be relentless on a month-over-month basis. Sure, year-over-year is going to look better, but month-over-month is showing that we're still getting that acceleration, and we're not seeing any of that real slowdown. So January PPI came in at 6% versus the estimate of 5.4, and then it was revised up last month, revised from 6.2 to 6.5. Core came in at 5.4% versus 4.9%, and obviously the previous was also revised higher. So we're still seeing these pressure points, and we don't see, and again, this is the supply chain. This is why prices paid is going higher in the regional feds. And it has been. And we talked about this last month. We keep showing leading indicators highlighting that, look, inflation is not going anywhere right now. And that's when you start looking at the sticky CPI measures stayed at 6.7% in January, while flexible measures eased slightly to 6.4%. But again, the former still hovering near the highest, fastest since the early 1980s. Goods disinflation continues on the core goods side, which came in at 1.4% year on year in January, while core services came in now at 7.2% year on year. So the core disinflation, and again, this is leading to that stagflation talk that we continue to have, where the driver is really going to be services. It's going to continue to be services and not goods. U.S. CPI services, excluding rent, saw a 3-month annualized percent gain reaccelerate in January up to 5.2% versus 3.1%, as we have been talking about. When you look at the small business data, small business optimism index rose to 90.3 versus the estimate of 91. Net percent of firms expecting better economy rose to minus 45%. Hiring plans moved higher, but CapEx expectations dipped. So again, we're kind of stabilizing at these lows, and that's what we've been saying. Is like it's going to be tough to continuously go down as we start to see some of this flatlining, but the CapEx number is the biggest concern for growth. Per the small business, 46% of small businesses have been raising compensation, but only 22% plan to do so in the future, which is the smallest share since May of 2022. The question is, does that stick? Can they hire people at that assumption? And that's why the compensation index was coming down. Now it's reaccelerating, which again leads to that component of prices paid, prices received, and keeping some of that inflation. As of January, the net percent of small businesses raising average selling prices fell to 42%, still elevated relative to history, but a move lower from the peak. But going back to 2000, you get an idea of just how high that is. So poor sales growth as most important problem, not gaining much traction at all. And again, the retail sales kind of show why, but that again, the higher prices continues to be the concern, and it's come down, but given how elevated it is versus historics, gives you the idea, gives you the backup showing that, look, the inflation increases is broad. It's across a wide swath of goods. And here's another example of how. Labor tightness crept back in a bit in January. A small business update, hiring plans moved higher along with business perception that openings are hard to fill. So again, keeping some of that inflationary pressure. And then when you look at CapEx plans, you can see that things have shifted down once again. And you'll also see that companies are comfortable with inventory, which is going to result in, again, a little bit less manufacturing, less activity, because they don't need to build up that inventory, which is why CapEx is coming down, which is going to put some pressure on employment, which again is something that we see coming down the pike. But even though all of these data points show that reduction in employment, you still don't have a very high participation rate that's keeping things fairly tight, which is again going to be another driver of inflation. So that's what we have for you on that side. In the next segment, we're gonna go deeper into retail sales and some of the important pivots in that realm of the consumer.